Thank you very much for putting the case for this great debate. I hope it's a great debate. My job is to make a case for company voluntary arrangements. And before I start, a show of hands. How many people have been involved in a company voluntary arrangement as an advisor or director or investor? About a third of the room, so that's pretty good. So I'm preaching to the converted, and hopefully I'll hold on to my vote. My premise is that CVA is the best recovery tool. You hear a lot about banks and creditors looking to try and work out a deal, try and avoid insolvency. Clearly CVA is a formal insolvency, but in my view it's the best one that we can use. Therefore, we should be seeing lots of them, shouldn't we? But last year was an all-time record. There were just under 800 CVAs used in the UK, the whole of the UK last year, which is interesting because that's not really what the government expected. The government has a view that we should be using more company rescue tools. Indeed, part of the Enterprise Act changes was to encourage more company rescues using CVA and administration. Why don't we see more being used? I think a lot of insolvency advisors ignore them, frankly. Are they too difficult? Are they too much like hard work? Do we have to spend a lot of time talking to creditors? Or do we just impose a pre-pack on them? The government has researched and asked people to research why CVA is not being used and then fails to actually promote them in any way, shape or form. That's for the profession perhaps. And I think a lot of professional advisors, bank managers, investors and creditors are not really fully up to speed with them. Some high profile cases recently might have helped that, but there are still insufficient trading CVAs which are carrying on and recovering, in my view. Okay, we're going to look at the upsides and then there are some downsides. A CVA is very, very flexible. You can write a deal any way you like. Essentially, all you need to remember about that deal is, apart from it being legally correct, is it's offering to pay back X pence in the pound over Y period of time of debt. There is no prescription in law that says it has to be XP or Y. It is whatever the company's proposals state and what is accepted by the creditors. One of the criticisms of CVAs, however, is that directors remain in control of the business. Well, they got it there in the first place, so should they remain in control? And that's part of the assessment that we need to make as turnaround advisors and insolvency advisors. There's a time-defined process. Once we file a CVA proposal, by essentially filing the nominee's report in the court, then we have to hold a creditors meeting in a time-defined period, and that makes people come together and make a decision. Apart from the creditor apathy, which we tend to see because most creditors don't bother. The HM Revenue and Customs always do, but most other creditors seem to ignore it. In my view, done properly, it's cheaper than administration, and it has some special benefits which a lot of people aren't aware of. David referred to earlier about the ability to terminate lease obligations. I'm going to explain how that works later. These are the good upsides, okay? And at the end of that process, if you get a deal, you have compromised the creditor's debts. Remember that point because it's important. CVAs weren't around until, it's not working out here, in 1970s and 1980s recession. There was no rescue tool. Administration and CVA didn't really exist. It was liquidation or receivership pretty much. Okay, there were schemes of arrangement and the London approach, but they were pretty small numbers and very high debts. Government asked Cork to set out a new act which looked at working out solutions, CVAs, if you like, a Chapter 11 type approach. And Part 1 of the Insolvency Act set that out. I like Part 1 of the Insolvency Act because it's pretty non-prescriptive. It doesn't actually say what you should do or how you should do it. It just says the broad rules. Part 2 sets out what the administration should all be about. And I know the rules have changed and there's substructures and new introductions from the Enterprise Act and so forth. So one could say that in 1986, the company rescue culture was born. Well, it took a very long time to kick off because I'm not sure if anybody knows the actual numbers, but I think there were 2 CVAs in 1987. That's taken a long time to build since then. What does a CVA mean to a client? If you start getting involved in Section 1 of the Insolvency Act, Part 1, Part this, most directors will lose the interest that they might have had in doing something with you. What you've got to explain to them is, this is a deal. It's very straightforward. Let's do a deal that offers the creditors a return, that would be better than they would get in a liquidation, and possibly better than they would get in a pre-pack situation. Providing, and these are the key words, that deal is fit, fair and feasible, and a licensed insolvency practitioner is prepared to promote it to the creditors and negotiate with the creditors on the company's behalf, in a sense, then if you get 75% of those creditors voting in favour, you've got the deal. Yes, the creditors can make modifications, they can seek to make changes, people like HMRC and landlords will seek to try and make changes, but essentially you've got a deal that's legally binding. And that process, again, compromises creditors' debts and imposes a moratorium on those creditors. I'm not going to go into moratoriums before the CVA process. I personally have never used it. I know some people have used it, but personally we haven't at this stage. There are some key cases that we have to look at, and this will help you understand the power of the CVA to terminate lease obligations. The one in red there is door bar versus all time securities. A lot of people will have heard of that. And then there's another one which follows on, which I'm going to ignore, but it's called Rate Can Call. These help us sort out the landlord issue. Lots of people say, hang on a minute, I can understand that creditors are owed money, but what about landlords who have got a lease and they're owed future rent? Back in 1994, note the date, 1994, the court held that it wasn't an unfair prejudice or a material irregularity to allow a debtor's future liability under a lease to be included in a voluntary arrangement. In that case, it was an IVA, or a Mr. Doorbell. Cancall came along later and said, yes, it extends to CVAs. So for the first time, future creditors were able to be bound by a voluntary arrangement. And I know there'll be some lawyers in the room, I'm looking at one now, who might agree and disagree on some of the detail, but essentially that's what it set out to do. Understanding what a contingent creditor is a whole subject of its own. Contingent creditors include future rent, service charges, schedules of dilapidations under a lease, and so forth and so on. But essentially, under Doorbar, we can bind them in, providing we get the deal accepted by the requisite majority, and you could argue that that applies, therefore, to all forms of contract, because essentially, the landlord and tenant lease is a contract. So, you can look at management contracts, you can look at employment contracts, you can look at contracts with suppliers, you can look at contracts with customers if there are any onerous details in that. So, if you write the proposal properly and set out the terms correctly and have the deal approved, then the future rent can be bound. There might be an exception, and one of my colleagues and I were talking about this today. You may set out a proposal that says future rent will not be bound if the company continues to occupy the property, or it might be that it is bound after a given period of time. I think JJB Sports set out varying stratas and types of landlord issues. Essentially, there are a number of deals within the deal. In my view, you've got to do it properly, or it isn't really the case that future rent will be included within the CVA, and the tenant should continue to occupy and pay the landlord the rent. Unless, and this is what I like about CVAs and I like about Part 1 of the Insolvency Act, what if you went to the landlord and said, we want to do the following, we'll occupy the property for an agreed period of time. With your support, we might pay a reduced rent, or we might pay a monthly rent. JJB and Black's Leisure did that as well. Or we might plan a future surrender, or there might be the lease coming to an end in 7 months' time, can we occupy at a reduced rent? And the key to all of this, it sums up the CVA process. It's a deal. Let's go and talk to the creditors, let's go and talk to the stakeholders, and try and construct a deal and get consensus. My marketing manager, who's at the back of the room, worked for us for about 2 years and then said it all boils down to that one word, doesn't it? Do a deal. The answer is yes, there's a framework that you've got to work in. But as Winston Churchill said, jaw has got to be better than going to war with the creditors. And a lot of directors have already gone to war with the creditors when we get involved with them. And one other constituency that we have to think about, which is well known, HM Revenue and Customs. Now, there's a lot of nonsense talked about HM Revenue and Customs, but essentially the structure is, if the tax collector can't collect, they have a number of remedies. Send in a field officer to try and collect the tax. Well, in a service business, what are they going to collect? Desks and chairs? The people walk out the door, as David said earlier, there's no real assets. They can go for county court judgments, they can go for writs, which they very rarely use, but essentially they'll pass it to the enforcement department, who will then say, look, if you don't pay this debt, we're going to issue a WOP, or a winding up petition. And what we're finding is they've cut the steps. And I remember going to a TMA event at Salins last year where the deputy head of the debt management and banking said we're going to cut the number of steps between enforcement, starting on a case, and a winding up petition being issued. What we're finding is 7-day warning letters are being used. Enforcement wants to get paid in full. That's its job. It can't accept a deal where the debt is compounded. It has to get the payment in full. So that leaves the voluntary arrangement service. BAS is based in Worthing, and it handles all IVAs, partnership voluntary arrangements, and CVAs. And they're a very smart bunch of guys. HMRC will not support CVAs, we're told. Who are we told this by? People in my profession, accountants, bank managers, and so forth. Well, they really should know better, because the 7-day warning letter that I referred to before on page 3 says, please consider taking advice from an insolvency practitioner and consider proposing a voluntary arrangement. And yet people still say HMRC will not support a CVA. They won't support a CVA if it isn't fit, fair, and feasible. They will if it is. But they are quite tough negotiators. I call them the most sophisticated creditor out there because they have seen thousands of these things over the years. And they won't just accept Hobson's choice, you know, take 0p in liquidation, Mr. Creditor, or 50p in a CVA. It's not the way they work. They'll look at the merits of the deal, they'll look at the structure of the deal, and they'll look at the forecast to see if it's fit, fair, and feasible. David's made a good case for pre-pack and administration. I'm not really going to cover it. Safe to say, for me, the big issues are, once the administration appointment is made, the director's not in control anymore, obviously. In a pre-pack, they or a third party have to buy the assets. Where's the money coming from? If the third party is well capitalised, that's not an issue, is it? But where's the working capital coming from if it's a quasi-phoenix? And often, they put all of the money into the business in the first place. Companies entering into a pre-pack or administration are inevitably going to suffer marketing damage. The perception in the marketplace is you've stiffed the creditors. It's a pretty crude word, but essentially that's what Jeremy Paxman and the leader column in the Telegraph and the Times called it 2 years ago. They felt that it was appalling that creditors were being dealt in this way, and we all know that it has merits. Statement of Insolvency Practice 16. I think it hasn't helped pre-pack administrations because it means essentially you have to start talking to the stakeholders before you finalise the process. And SIP 16 is a guideline for us, but who do you talk to? Do you talk to HM Revenue and Customs? Do you talk to the suppliers? Do you talk to the main supplier, or do you talk to all 250 suppliers on the list? So you've got to be commercial, I think, in the use of SIP 16. And I would put forward this. If we promote a CVA that essentially hides the business down or out to another vehicle, that has the same benefits, if you like, of a pre-pack, but it doesn't have the downsides of the administration, and there's something coming back to the creditors in the fullness of time. But you'll say CVAs don't always work, and here are the main reasons why. Number one, over-optimism of the directors when they're proposing the deal. Number two, when we file a CVA certificate at Companies House to say the company is now in a CVA, the supervisor certificate flags to the credit rating agencies that the company is in an insolvency mechanism. It's compromised its debts. Why wouldn't it give a credit rating? It's now got a stronger balance sheet. That's a losing battle with the credit rating agencies because they don't get that point, I don't think. But in their view, it's an ongoing insolvency, and therefore the company shouldn't have any rating at all. So it's not 0 out of 100 or 10 out of 100, it's just not rated. And therefore, if you try and tender for government work or council work, you can't. On the front page of the tender document, it says, are you in a company voluntary arrangement? Have you been in pre-pack or administration or liquidation? The answer is yes, don't bother. Okay then, Mr. Government, Department of Business, Innovation and Skills, what does that mean for the company risk culture? The main downside that David referred to is the company has to have the ability to pay back some money in the future. And again, the over-optimism of the directors usually says, I can afford 100p in the pound in 3 months. We would tend to take it out longer than that. And I do know some of my competitors who will say, take the money that's owed to the creditors, divide it by 24, there is your deal. There's not much science involved in that. Against which the creditors almost always, as unsecured creditors, lose out in an administration. Having said that, administrators must obtain a better result for creditors than a liquidator would. So typically you could say that it's better than liquidation, but maybe not as good as a CVA. I had lunch with a banker who said to me, "Oh, but Keith, dealing with companies in a CVA means that my cost of capital rises. And that can make it problematic for me to want to consider provision of invoice discounting, loans, EFGs, and so forth." So that's something that you have to consider if there's a lot of secured debt. In my view, banks would prefer some form of workout, and they might live with that, or they might want you to manage away to another provider, another facility. So, in summary, before I go into a war story, it's flexible, it's powerful, you can terminate contractual obligations, you can cut costs, and you can allow a deep restructure of the business, but there's got to be that change. And too often CVAs accept the status quo, the same management, the same processes, nothing changes. And HMRC's first question is, demonstrate to me, Keith, why I should support that deal. What will change? Because if it doesn't change, we might reject it even if it's 100 pence in the pound. And we've had one recently rejected at 100 pence in the pound by HMRC. So that's pretty liable. In my view, people in this room, turnaround managers, non-exec directors, chartered accountants, we need to get you involved in more turnarounds and in more CVAs in particular. If we can demonstrate that we've beefed up the board, as I'm going to demonstrate to you with my war story, you're more than likely to get support of the creditors because something has changed, notwithstanding the credit rating issues. Okay, so that's what a CVA does. How does it work in principle? This might be a bit more interesting. The case that I'm referring to is based in West London. It had a very large warehouse, a huge warehouse. It had 7 retail stores, mainly in West London and a couple on the south coast. When we got there, the accounts showed that it had lost 450 grand in 2008-09, and it had lost more than $500,000 the following year. And when I asked the question, why did you lose money? Oh, we had problems in the warehouse. So not a single comment about poor management, margin analysis, were they buying the right product, were they selling the right product. And when I walked around the warehouse, as I tend to do quite a lot in the current climate, it was full of stock. All stock that they thought would sell. So, Royal Bank of Scotland Global Restructuring Group had been involved. Nobody had really come up with any strategy. What we looked at was, well, is it a CVA? Potentially it is. Is it a pre-pack? Potentially it is. Difficulty though in the landlord issues. And one of the issues that you didn't mention, which is TUPE, in that we had over 150 people involved in this business. And if we pre-packed it, what would the TUPE issues be? And I'm no expert in TUPE, and we could talk all night about that. So the strategy was, let's do a deal, let's talk to the bank, let's find out what their objectives are. They wanted the overdraft paid off, funny that. They wanted Lombard paid on a £300,000 leasing contract on a piece of software to run the warehouse, which had never worked. And they wanted Streamline protected. And at that stage, RBS owned Streamline, but they had to sell it eventually. Directors were fighting with each other. The average age of the board was over 75, and that's because of 3 non-exec directors over 80. Nothing against 80-year-old non-exec directors, but I felt we had to change that. And we needed to outsource the warehouse. We had this huge lump of property in West London, which was costing a fortune to lease, and really wasn't very efficient. In my job, if you go in to do a CVA, the first thing you think about is what? Cash. How are we going to get paid? Number 1. Number 2, how are we going to get paid? Number 3, how are we going to make sure that the employees are paid, and so forth and so on. So the first thing we did, we are closing down sale in the shops that we'd identified that were non-performing. And thankfully we had enough management information to tell us that. Aim being to drive cash into the business, turn current assets into cash, use that cash to drive the recovery. One Saturday morning, we brought the M4 in West London to a standstill with bargain hunters, tailing back 4 miles, waiting to get to the warehouse sale. And we just put it on the internet, that's all we did. And off it went. It generated almost £400,000 that weekend of cash that the business didn't think it had. And that made a fundamental difference to the viewpoint of RBS, because guess what? The overdraft was paid off, wasn't it? So we achieved the bank's objectives. We looked at closing down the stores, and we thought that the mail order side and the online business was doing really well and wanted to protect that. But it was a paternal type business. They hadn't made anybody redundant in years. So we had to do that. Does anybody know what RPO stands for? Neil, you're not allowed to answer. Anybody else? Okay, Neil, what does RPO stand for? Redundancy Payments Office. How many people have heard of the Redundancy Payments Office? Okay, that's important that people are more aware, in my view. Because as part of the CVA process, we made these guys redundant. RPO paid their redundancy claims to the cap, which was probably £350, £400 at that stage, and they paid the Blue Notice eventually, and they'll not pay it until the CVA is approved, but essentially there is a safety net there for the people who left. From my point of view, driving cash, the key was we couldn't afford to pay the redundancy. I'm not going to take the 400 grand I've just made in a warehouse sale and pay it out in redundancy in Blue Notice. It's just not the right thing to do. We found a company in Sunderland who would do the warehouse work and the fulfillment far cheaper than they could do it as a company, and the savings there were probably 300 grand. Shut in these extremely expensive shops. I mean extremely expensive. One of them, the rent was 300 grand a year. Cut costs by that. We had to say goodbye to 70 people, and again, just to iterate, there was no redundancy cash cost to the company. Yes, the claims subrogated into the CVA eventually. We forecast 5 million, not 8, because the business was going to be smaller, and we set out a plan that said this is a doable CVA, but here's the big change. Paternalistic MD, stand down. You're 70 something, you've done it all the same way for 50 years, well done you, time to stand down and let somebody else take over. And the son was actually very good. We took out the 3 non-execs and we put in an FD who was a chartered accountant to run the MI and liaise with the bank and with the supervisor. We brought in a retail expert who had been with Tyrac, it's a claim to fame or not, I'm not sure. And the operations guy who had been brought in to fix the warehouse, we made him head of operations and helped us plan what was a long-term move to outsource the warehouse. Then we went back to global restructuring and said, we've paid off your overdraft, we don't want to pay the Lombard Asset Finance Facility, but give us 12 months and we'll come back to you with a plan, which we did. And brilliantly, global restructuring and streamline continued the facility. A lot of the turnover was on credit card and debit card, so that was, it would have been catastrophic if we'd lost that. So the various issues that we have to try and balance. The deal was 30 pence in the pound. Inland Revenue was nearly a third of that. They were by far the biggest creditor and by far the biggest element in the room, and they were more than happy to vote for it because they saw change. We introduced a profit ratchet that says if we do more profit in the first few years than we expect, then we'll pay more money into the scheme, and that's actually happened in the first 2 years. So far it's a success. Warehouse has now been outsourced. I go back to what David said. You know, there are some. You look at companies that are too bust or not bust at all. Sometimes you've got to look at the management and say, actually, it's not the degree of insolvency. It's what about the management? Have they got the guts, the determination, and the drive to make this work? Can we supplement that? Can we support them? If not, you're wasting your time with the CVA because they've got to change, or accept change, or accept supplementation and support. And in that case, a pre-pack to a third party, if there is an option available, might be a better option. I hate this word zombie, but because it's current, I put it in there. In my view, how am I doing for time, Jonathan?
You're okay.
In my view, where there is a determination in management, where there's a viable business, if we can cut costs and introduce PMA guys to help with change, then a CVA is far better than a pre-pack, only if you drive that cost restructure, management restructure, and consider issues as fundamental as, has anybody thought about the marketing here? What is the image out there of a company going into a CVA? Well, it's not brilliant, is it? So you have to manage the marketing externally and also manage the marketing internally. It gets a bit wearing for somebody to answer the phone and I hear you gone bust is the first thing that somebody says to them. So you've got to manage all that process as well. So in my view, CVA is the best strategy to use where those circumstances prevail, but sometimes pre-pack or a straightforward, plain vanilla liquidation is the right answer. So, I think I've come in under time compared to last week, which is better. We're going to have a little bit of debate, and I hope you've got lots of questions for David, and that I've explained it so succinctly that you've got no questions for me. But if you have, I'll look forward to taking them.